Hello everyone. Now let's see the additional or auxiliary duties of customs. These duties are levied under special circumstances. So these duties are not permanently levied duties. They will be levied if those circumstances arise and only to meet that particular circumstance. Once that circumstance is gone, the duty can also be removed by the government. Okay. So these are circumstantial based duties. So we'll see what is the circumstance and then what is the duty to be levied and the logic behind that duty. Okay, so these duties are very logical based duties. Let's see. Short question can come 2 marks, 3 marks on some aspect of this duty, not the whole duty, but some aspect, or a practical question. So let's see. First is the protective duty. Now in protective duty, the logic is to save the Indian industry. Logic is saving the Indian industry from global competition. So if for example there is an industry like, take any example like steel industry, and because of very cheap steel available outside India, if it is imported into India uninhabited, means unprotected, then it will kill the Indian industry. The Indian industry will become dead. Why? Because if cheaper steel is available from outside India and if it is imported in bulk quantities and of course good quality as compared to Indian manufactured steel, then Indian companies will shut shop. They'll be closed down within 6 months. So to protect the Indian industry, government has to impose heavy duty on imported steel. So that heavy duty is called as protective duty. And as the name suggests, the reason of this is to protect the Indian industry. As simple as that. So let's see. Very simple. Protective duties are levied by the central government upon recommendation made to it by the Tariff Commission. Tariff Commission, like in GST, there was GST Council. So here there is a Tariff Commission which gives the recommendations to the central government. And upon it being satisfied, the circumstances exist which render it necessary to take immediate action to provide protection to any industry established in India. Now these are the words that would appear in the paper. Okay, underline these words, remember them and write them. If a short question comes, 2 marks, what is protective duty? So rest is grammar. These are the technical words. Circumstances exist which render it necessary to take immediate action. What action? To protect the industry established in India. Such duty shall for the purpose of the Act be deemed to have been specified in the first schedule. So remember this point. Protective duty is nothing but the rate of basic customs duty. This is basic customs duty rate only. So if this rate is say provided by the government as 75%, so your basic customs duty will become 75%. The normal schedule 1 rate might be 15%, but that 15 will get replaced by 75%. Okay. Then this notification would be introduced in the parliament by way of a bill. The notification has to be passed by parliament, and if it is not passed within 6 months of introduction in parliament, then the notification ceases to have force, but action already taken remains valid. Means whatever duty is recovered during the 6 months period will remain valid. Then duration will be shall be effective only up to the and inclusive of the date if any specified in the notification. The notification will specify the time for which Indian industry can be protected. They cannot be protected for lifetime, so it will have a limited time. Then power of the central government to alter such duties. Obviously the government can alter the duty also. The government may reduce or increase the duty by notification in official gazette. It can reduce, it can increase. Right, like for example 75% is imposed and it is found that the imports have shut down. So then at least some import should take place, na? So we cannot totally shut down the imports. So okay, then we'll reduce it to maybe 60%, maybe 50%. Or even after imposing 75% duty, if it is found that nothing is happening, imports are still happening unabated, then the government can increase the rate also. So increase, reduce will keep going on. However, such duty shall be altered only if it is satisfied that such inquiry, after such inquiry as the things fit to things necessary, that such duty has become ineffective or excessive. So first inquiry will be done to find out the effect of duty on import. If it has the effect of totally shutting down imports, then okay, we'll reduce it. Or if the effect is not there, there is no effect, as I said, the imports are taking place unabated, so then it can be increased also. For the purpose of securing the protection intended to be afforded by it to a similar article manufactured in India. That is the intention, to give protection. Then in case of increase in duty, approval of Parliament is required. Because original duty was levied 75%, at that time Parliament bill was passed. If it is increased to 90 or 100, then again it has to be passed by Parliament. So it says, if there is any increase in the duty as specified above, then the central government is required to place such notification in the Parliament within 7 days of assembly and seek its approval by a resolution moved within a period of 15 days beginning with the day on which the notification is so laid before the Parliament. So it has to be laid in the Parliament and then approved within next 15 days. And if the Parliament recommends any change in the notification, notification shall come into effect with that change. However, anything done pursuant to notification before the recommendation of change shall be valid. Simple points. Then comes next one, very interesting one, and that is called as the safeguard duty. Section 8b. Now, safeguard duty means to safeguard. To safeguard again means to protect. So this is similar to protective duty, but the cause is different. The reason for levy is different. Protective duty can be levied just to protect the Indian industry. It's a very crude method, a raw method. This is a more refined method. Safeguard duty is a more refined form. It says that if the imports are going on and domestic production is also going on, so normally it makes an equilibrium. Like for a market in India, for whatever goods, 70% is domestic production and 30% is import. Fine, no problem. But if it happens that there is a sudden increase in import of goods, sudden increase, rapid increase in importation of goods takes place of that particular goods. Now obviously that sudden import, the increased import would take place from one or two countries, maybe one country, maybe a group of countries. Not everywhere, but some countries. So if the government notices that there is a sudden increase in the importation of goods, and because of that there is a threat to Indian industry, then the government will act against those countries only from where the imports have increased. So this action is a very concise action. Like if this finger is paining, we will not plaster the whole hand, we will plaster this finger, right? So this is a precise action. If the imports have increased from a country like Germany, we will import this duty only on Germany. If the same goods are imported from Russia, we will not impose the safeguard duty, because Russia is exporting only that much goods that it had exported last time also. So there is no threat from Russia. The threat is from Germany because the quantity has increased from Germany. So we will take action against Germany. And the section also says that if action is to be taken against a growing nation, that is underdeveloped nations like India, which are not developed countries or not MFN countries, then it has to have a requisite share in the total imports of that article into India. That is 3% share. So if suppose there is import of certain goods like for example watches, if watches are being imported into India and watches are imported from so many countries, it is also imported from a growing country like Tanzania. It's not a developed country, it's a growing country like us. So if the import is taking place from Tanzania and its share in the total imports of watches last year was hardly 2.1%, means out of every 100 watches or 120 or whatever, only 2 watches were coming from Tanzania. So it has a meager share, a minor share in the total imports. And this year it happens that this 2% becomes 4.5%, 5%. So there is increase. There is increase, but how much? 2 will go to 5. So in percentage terms, it is more than 100% increase, but in overall terms, it is nothing. It's chiller. It's just a change. It's simple. So we will exclude those people. No duty can be imposed against them if their share was less than 3% of the total imports of that goods into India. Okay. And if suppose action is to be taken collectively against a few developing nations like Tanzania and Uganda and Mozambique, Ethiopia and Honolulu, whatever. So if 2, 3, 4 countries have started exporting higher numbers to India, then if action is to be taken against all of them together, then their share should be more than 9% of the total imports into India. If collectively their share is more than 9%, then yes, action can be taken. Or if action is to be taken against one country, then its share should be more than 3%. So if action is to be taken against one developing nation, its share into total import of that article should be more than 3%. And if a collective action is taken against number of developing nations, then the total share, their aggregate share should be more than 9%. 3 and 9, remember like that. 3, individually 3, collectively 9. Okay, so that's the point. So let's see now. Circumstance. When the goods are being imported in increased quantity, underline increased quantities, and are causing or threatening to cause serious injury to domestic industry. Causing or threatening to cause serious injury to domestic industry. If there is no domestic industry and there is no need for, there is no serious injury or threatened injury, then we will not impose this duty. The central government may exempt such specified quantity from payment of the whole or part of the safeguard duty. Now this is also important. The government may exempt specified quantity, means there will be a certain limit fixed. If the import is within this limit, no duty will be charged. If imports exceeds this limit, then the duty will be charged. Right? Like for example, last year the importation was 30% of the total demand in India. So if this year also it is around 30% or maybe a little bit more, then that's fine. That's fine. Then there is no question of levy of safeguard duty. So safeguard duty can be levied, but there will be a minimum threshold also. Threshold exemption. Like if this much quantity is imported, we will not charge. If it goes beyond this quantity, then we will start charging. Then procedure for levy. The central government is empowered to impose safeguard duty on specified imported goods. Such duty is permissible under WTO agreement also. Government has to conduct an inquiry and then issue a notification. Inquiry for what? Inquiry for damage. Damage to domestic industry. The duty is in addition to. Now this duty is in addition to other customs duties. So this is not in lieu of the basic customs duty. No. Basic customs duty will be charged separately and safeguard duty will be charged separately. Then exceptions. In case of imports from developing countries, such safeguard duty can be imposed only if import of that article from one country exceeds 3% or aggregate imports from more than one country exceeds 9%. Now this country means what? One country or more than one country means which countries? Against whom the action is to be taken, against whom the safeguard duty is to be charged. So if you are charging safeguard duty on what did I say? Tanzania, then import of watches from that country last year should be more than 3%. So these percentages will be taken normally of the last year because last year's data will be available, right? And collective import, 9% if you want to impose duty on more than one country together. Then no safeguard duty in case of 100% EOU or SEZ unit. If importer is 100% EOU or SEZ units, then safeguard duty will not be charged unless specified in the notification or the article imported or manufactured from goods imported is removed in DTA. If the SEZ unit is importing something into India, and if that goods is imported now in the increased quantities, still we will not charge duty on SEZ units, because ultimately they are going to export the finished goods. So they are going to import the inputs in bulk quantity, manufacture something and export it. So the thing which has come in is going to go out. So is the domestic industry affected by it? No. So then it is exempt unless it is specified in notification. If the notification issued by the government under this section specifically mentions that this duty is also to be charged on import by SEZ units, then it will be charged. Otherwise, it will not be charged. And secondly, the article imported or manufactured from goods imported is removed in DTA. If the article that they are going to manufacture in SEZ out of imported raw material is going to be sold in India, then the Indian industry is affected by it. So then we can charge this duty. In such cases, the SGD shall be, yani कि safeguard duty shall be levied on such portion of imported articles so removed. Means SGD will not be levied on total importation of inputs, but only those inputs which are to be used for manufacture of goods which are to be removed in DTA. Then provisional duty. Central government can impose provisional safeguard duty pending final determination up to 200 days. See, what it means is that inquiry is to be done. Inquiry that first of all the quantity has increased or not. If it is increased, then is it going to affect the domestic industry or not? Is it threatening their existence itself or not? Two things have to be checked in the inquiry. Firstly, has the quantity been increased? If yes, is it going to cause injury to domestic industry? If no, then we will not charge this duty. So what happens is that when a complaint is received by the government, complaint will be made by whom? The Indian industry. Look, steel is getting imported at a much cheaper price. Do something. So what the government does? It first imposes a provisional duty. It says, okay, from this day we will charge duty to protect the Indian industry. But it will be on provisional basis. Provisional means it is not yet final. So the duty will be imposed. At the same time, the inquiry will be set up. Then the inquiry committee will do the inquiry, will give its report to the government. Government will study the report, come to conclusion, and then they will finalize the rate of duty. So till this time, the duty was imposed on provisional basis, and then after full inquiry and investigation and determination, the rate will be finalized. So this has to be done within a period of 200 days. So therefore it says that it will be levied on provisional basis pending final determination up to 200 days. Means it has to be then finalized within 200 days. If it is not, then that provisional duty will lapse. But whatever is collected is collected. Whatever is done is done. Then maximum time of levy will be 4 years. Once it is finalized, it will be imposed for a period of 4 years. After 4 years, government will look at it again, that if we remove this duty, will the imports increase again? Is there a possibility of that? If no, then we will remove this duty. But if there is a possibility of again the imports increasing, then we will again extend the term by another 4 years. And thereafter another 2 years only. Because at a stretch, it can be imposed for not more than 10 years. So maximum is 10. So 4 at a time plus extensions, maximum 10. And for this purpose, domestic industry is defined. No need to study that. Means as a whole of like articles or directly competitive article in India, or whose collective output of the like article or a directly competitive article in India constitutes a major share. So industry word means the whole of it or those people who are having major share. That is industry. So injury should be caused to everyone or those who constitute majority. But if injury is caused to one or two minor khiladis, minor people, whose total market share is hardly 1%, 2%, not in majority, then government will not take action against, I mean to say, to protect these people. We cannot protect minority here. We are to protect majority, major share. And every notification, serious injury is also defined. What is serious injury? Causing significant overall impairment in the position of domestic industry. This you have studied in accounts and audit, impairment of assets, right? And threat means clear and imminent danger of serious injury. Then the notification has to be passed by both houses of parliament as soon as may be. Then next one is countervailing duty on subsidized goods. Very simple one again. Here the logic is that foreign country, in order to increase their exports, okay, in order to increase their exports, gives subsidy, the foreign government gives subsidy to their exporters at the manufacturing level or transport level or any other level. That subsidy is given. And because of the subsidy given by the foreign government to their exporters, the exporters will supply the goods at a lesser price to pass on the subsidy. So because they are receiving the amount from the government, they will reduce their export price. And as they reduce the export price, it will come at a much cheaper price as compared to the domestic Indian production. Because Indian government is not giving subsidies to manufacturers in India. So therefore they will not be able to compete and there will be huge imports. The domestic industry will be hurt. Injury will be caused. So again, to protect the Indian industry, what the government of India will do, it will impose a duty equal to the amount of subsidy that has been received. So Indian government will say, okay, foreign government has given you subsidy, pay it back to us. We will recover that subsidy from you. So if say 2000 rupees of subsidy was there, Indian government will impose 2000 rupees duty on importation of these goods into India. And this will again be apart from your other duties. Apart from the other duties are there, basic custom duty and all, they will be still there, and then this additional duty will be there. So let's see what it says. Very simple one. And the technical part remains same, that first provisional duty will be charged because inquiry will take time. Inquiry whether subsidy was given or not, and what is the amount of subsidy, how much effect it has got on the domestic production of goods in India, how much injury is being caused, all that inquiry has to be done. So in the meantime, first we will charge provisional, and then after doing all inquiries we will finalize the rate for the future. So that is given here. First circumstance, where any country or territory pays, bestows and it gives in accordance with law, directly or indirectly, any subsidy upon the manufacture or production therein or exportation therefrom of any article or on transportation of such article. Then upon the importation of such article into India, whether the same is imported directly from the country of manufacture, production or otherwise, whether it is imported from the same country or otherwise means from somewhere else also. Like for example, manufacturing of goods was done in Norway and Norwegian government has given subsidy. Now whether those goods are imported directly from Norway into India or we export from Norway to Finland, from Finland to US, and then from US we bring it into India, In both the situations, we can charge this anti-subsidy duty. I call it as anti-subsidy, okay, or otherwise. And whether it is imported in the same condition as when exported from the country of manufacture or production, or has been changed in condition by manufacture, production, or otherwise. Means, I'll take an example of this for you to understand. What it says is that firstly, if some finished goods is manufactured in Norway, so we took an example of what? We haven't taken example of any goods, so let's take an example like butter. So on butter there is a subsidy in Norway. Now whether you import this butter as it is in India, or you take it somewhere else, like as I said in Finland, and then from Finland you import it into India, in both these situations the anti-subsidy duty can be charged. So here if the subsidy is say 80 rupees per kilogram, so what Indian government will do, it will charge 80 rupees as duty under this section, okay. So here we will charge anti-subsidy duty of 80 rupees per kilogram, okay, in both these situations. Second point is that if butter is taken to Australia, you take butter to Australia. In Australia, you manufacture cookies, butter cookies, by using this butter, and then these butter cookies are imported into India. So what is imported into India? Cookies. Is there any subsidy on cookies? No. Subsidy was on butter, and that too in a different country. So can the Indian government charge anti-subsidy duty here? Answer is yes, it can still charge. So Indian government can again charge anti-subsidy duty, okay. How much? Because what is imported is cookies. So we'll see that how many cookies can be made out of 1 kg of butter. So if one packet of cookies require 1 kg butter, for example, then on every packet of cookies imported the government will charge 80 rupees. 80 rupees per packet, because 1 kg is consumed in one packet. So if one packet is imported, we'll assume that 1 kg butter is imported. So on that we will charge the duty. Understood? Simple. Then amount of duty. The central government may impose a countervailing duty not exceeding the amount of subsidy. See, the duty will be equal to or less than subsidy. It can be less, but it cannot be more than subsidy. Then subsidies which can or cannot be countervailed. This is also an important point. Which subsidies given by the foreign government to their exporters can be countervailed by us, and which subsidies cannot be countervailed by us. So let's see. Theoretical question may come on this point. So it says, the following types of subsidies can be countervailed under this section. Subsidy related to export performance. So if the subsidy is given directly for export performance, that if you export goods of a certain value, the government will give you this much subsidy. So subsidy is calculated on the basis of your exports, then that can be countervailed by us. Secondly, subsidy relates to use of domestic goods, means inputs, over imported goods in export article. Means government of Norway is giving subsidies to some manufacturers for using domestic inputs. So they say that if you use domestic raw material, we will give you subsidy, but if you use imported raw material, we will not give you subsidy. So it's a conditional subsidy. Then if that subsidy is given, it will be countervailed by us. And thirdly, subsidy has been conferred on limited number of persons engaged in manufacture or production of export articles. So if there are many butter manufacturers in Norway, but subsidy is given only to 2 or 3 people, then if those 2 or 3 people export their butter to India, we will charge this duty. Limited number of persons is when subsidy is given to limited number of people. However, countervailing duty shall not be imposed in respect of following. Remember, not be imposed in respect of following subsidies. Number 1, research subsidy. So if the government of Norway is giving subsidy to local manufacturers for setting up research laboratories for the purpose of research, then that subsidy cannot be countervailed by Indian government. Suppose if that manufacturer later on manufactures the goods and exports it to India, we cannot countervail that subsidy. So research activity based subsidies cannot be countervailed. Research conducted by or on behalf of persons engaged in manufacture, production, export, or assistance to disadvantaged regions within the territory of the exporting country. So if the subsidy is not related to exports but is related to disadvantageous regions, like in India we give so many subsidies for setting up plant and setting up manufacturing plant in rural areas, backward areas. So if similar type of subsidy is given by the foreign government to their manufacturers for setting up units in backward areas, disadvantaged regions, then that person manufactures the goods there and exports to India, we cannot countervail it, because we also do it. We also help our underprivileged and disadvantaged regions. And thirdly, assistance to promote adaptation of existing facilities to new environmental requirements. If the subsidies are given to cope up with environmental laws, then that subsidy cannot be countervailed. So governments keep doing it. Like nowadays, due to carbon emission and all, government is giving a lot of subsidies for solar power and so on and so forth. So that is to adapt the new environmental requirements now. So those types of subsidies cannot be countervailed. Then procedure is same. First provisional duty will be charged and then it will be finalized. And another point is that it can also be charged retrospectively. This duty can be charged retrospectively. Why retrospectively? Retrospective means from the past date. Why? Can anyone explain? Look, very simple. I have always told you that to become a good policeman you have to think like a thief. So think like tax evader. You know that if we bring these goods into India and the government comes to know, they will start charging the subsidized duty. So what you do is import in bulk quantities in a fairly small period of time. Like I'll order instead of importing say 10,000 kilograms of butter every month, I'll order 5 lakh kilograms of butter. That should last me at least 2 years. Okay, or within the expiry time of butter. I don't know what is the expiry time of butter. Okay, so we'll import in bulk, and after importing, when the government will come to know that such a person has imported so many goods and then so on and so forth, when they actually start charging the duty, I will not import any goods thereafter, because whatever I wanted I've already imported for the next 2 years. And thereafter if the government charges the duty and then wait for the import to take place, nobody will import because import has already taken place. So in such situations it is important to charge duty with retrospective effect, that all those who had imported these goods within the last 3 months from such and such person should pay this duty, right? So that's why retrospective levy. So all those people who had imported in past will also be liable to pay this duty. But what is the maximum retrospective effect that can be given? Let's see. Such duty can also be levied with retrospective effect for up to 90 days prior to date of notification. Means if you import goods today and this duty is charged within next 15 days, 20 days, 30 days, 80 days, 90 days, it can be applied to you as well. So you will become liable to pay this duty. Okay, so maximum retrospective effect that can be given is up to 90 days prior to date of notification. If the government is of the opinion that the injury to domestic industry which is difficult to repair is caused by massive imports, as I told you, massive imports were taking place in a relatively short period of time. And in order to preclude means stop the recurrence of such injury, to stop the recurrence of injury, it is necessary to levy countervailing duty retrospectively. Okay, but maximum retrospective effect is 90 days. So if your imports had taken place more than 90 days before, then it cannot be touched. Then maximum period of penalty. So it says the such duty, unless revoked earlier, means the government has also got the power to revoke it, can be imposed for 5 years. And the central government may, where there is a likelihood of continuation or recurrence of subsidization, extend the levy by further period of 5 years. Then what? After the next 5 years, then what? Then it can be extended for another 5 years, and then another 5 years, and so on and so forth. So there is no maximum time limit here. It all depends upon till what time the foreign government continues to give the subsidy. If they give subsidy, we will countervail it. If they stop giving subsidy, we will stop countervailing. Simple. So this revocation word that was there, this comes into picture when the foreign government stops giving the subsidy. If they give a confirmation to Indian government that we are stopping giving subsidy, then Indian government revokes this duty. But if they continue subsidy, we will continue to charge the duty. And then there is explanation. There is no need to go through that. It's a very technical explanation. What do you mean by subsidy? So go through it in practical sense if you want to practice in customs later on, but not from exam point of view. Okay. Then next is anti-dumping duty. Anti-dumping duty, as the name suggests, dumping means big quantity of goods dumped. No. Anti-dumping is not about dumping of goods. Here dumping means difference in price. Dumping means difference in price. Which prices will be compared? Your local market of exporter, and the export price. Say for example you are Sony, you manufacture a camera, a handycam, and you sell that handycam in your country, the country of manufacture, at say $40, and you are exporting the same to India at $21. How is that possible? You sell in your own country at $40 and you are exporting it to India for $21. How come? What's the reason behind this? The reason for dumping lies in your costing. Have you studied costing thoroughly? Yes, then very good. What the costing says, especially the marginal costing principles, that if you produce in excess of demand, if there is a market, there is a demand of the market, and if you produce in excess, means supply increases. If the supply increases, the price will crash, and as the price will crash, you will suffer the loss, because your variable costs for one unit remains same, your fixed expenses are also there. So if the prices reduce, it will cut down your profit margin, and therefore you will go into loss. Why you went into loss? Because of excessive production. So what you do in that situation is that if your production is more than the demand of your local market, don't flood the markets with the goods. Rather what you do is you supply the excessive production in other markets, that is export market, that is Indian market. So if you are based in US and you have produced a lot of goods there, supply in US to the extent required, the balance you supply to India. And now comes the principle of marginal costing, that if your fixed expenses are already recovered in US, then you are only left to recover the variable expense. So then your sale price can be variable expense plus profit. है ना? So that's how you sell to India at a cheaper price as compared to your domestic market. So since you have to recover the fixed cost from your domestic market, you are selling at a higher price, $40. And then after recovery of fixed expense, you can sell your goods to India, excessive production to India, without charging fixed expense. You only charge marginal cost plus profit. So you can supply $21. So for you it's very good. From costing point of view, you have done excellent planning and all. But the problem is the Indian goods, because people who are manufacturing comparable goods in India have to recover the fixed expenses as well as variable expense. So they will not be able to compete with your price of $21 because they have to recover both the fixed and variable in India. So their costing will be more. So the goods will not become compatible. Hence the government will impose anti-dumping duty on imported articles. Okay, what is the dumping? How much duty will be imposed? Equal to the amount of dumping. An amount of dumping is the difference between these prices, your local market price and the export price. But first we'll adjust the differences of markets. If there are any differences, we'll adjust them and then we'll see, okay, what is the difference. That difference will be imposed by Indian government as anti-dumping duty. Got it? So that's the simple logic in the least possible words that I can explain. So let's see. Circumstances of levy. Where any article is exported from any country, now you just write down country like USA or territory to India at less than its normal value. Normal value means the price at which this person would sell in US as adjusted to bring in it line with export market. This is domestic market, this is export market. So obviously there are going to be some differences. So we will first make adjustments for those differences in the local price. So we'll take the local price of US, we'll make those adjustments plus minus and then we'll reach at normal price. Normal price is the price that you should have charged for export to India. But your export price is very less. So difference in normal price and export price is called as margin of dumping. It's called as margin of dumping, and duty will be equal to or less than this margin of dumping. See, amount of duty. The central government may impose anti-dumping duty not exceeding the margin of dumping in relation to such article. Levy of such anti-dumping duty is permissible as per WTO agreement also, and however anti-dumping action can be taken only when there is an Indian industry producing like articles. Obviously there should be injury caused to Indian industry now. If there are no like articles manufactured in India, there is no injury to be caused. If there is no injury, why we will charge the anti-dumping duty? Let the things come at a cheaper price. It's good for the Indian market. Exceptions are again that 100% EOU and SEZ units. If they are the importers, anti-dumping duty will not be charged. And provisional, again, first the duty will be charged on provisional basis, and then after examination of all the scenarios, we will finalize the rate of duty and refund the duty extra collected. If suppose provisional collected is 5,000 per unit and final duty comes to 3,000, so 2,000 which is collected in excess will be refunded. And here again it can be charged with retrospective effect for the same type of scenarios that like in last case we had seen that the subsidy was there and somebody had imported goods in bulk. So same thing can happen here now, that we will import the goods at a cheaper price in large quantities into India, very large quantities, and once imported, if the government even comes to know later on that such an import has taken place and something is being sold in India at a much cheaper price and the domestic industry is getting injured, if they impose a duty and then wait for goods to come, that let the goods come and we'll charge the duty, nothing is going to come. because we have already imported stock of next 2-3 years. So therefore, retrospective effect. So idea is the same behind retrospective effect. See, it says that where there is a history of dumping, means there is a long-term dumping going on, which caused injury, or that the importer was or should have been aware that the exporter practices dumping and that such dumping would cause injury, or the injury is caused by massive dumping of an article imported in relatively short time, which in the light of timing and the volume of imported article dumped and other circumstances is likely to seriously undermine the remedial effect of anti-dumping duty liable to be levied. So even if the government levies the duty for remedy, it will this whole transaction will undermine, because it has already been done. So therefore we will have to impose retrospectively to cover the transaction. Then the government may levy anti-dumping duty retrospectively for a period up to 90 days again. Maximum period is again similar to that subsidy wala duty, 5 years, and then extendable by another 5 years, and then another 5 years, and then next 5, and then 5 and 5 and 5. No ultimate limit. Till the time the dumping goes on, till the time you export to India at a cheaper price as compared to your normal market price, we will continue to impose this duty. Till the time the cause exists, the duty will also exist. And then there is another point, circumvention of anti-dumping duty. Interesting one. Circumvention of law, we normally call it as. Circumvention means to circumvent the law. Means if this is the law, you circumvent it. Like for example, best example, you are not wearing a helmet. So that is violation of Road Act. Okay. But you know that on this particular square, the police walas will be there and they will catch you and ask you for helmet, and if you don't have the helmet, they will make a challan and take fees. So what you do is you avoid that square. So you continue to avoid the law. You continue to violate the law, but you will not go to this square. So what you do is that you take a turn, right turn, and small gullies. So you will travel in the gullies and then again join the main road after that square. So that is called as circumvention, to circumvent. So what you can do here is you can circumvent the anti-dumping duty also by doing certain transactions. How? Let's see. So it says, where the central government on inquiry is of the opinion that circumvention of anti-dumping duty has taken place by either of the following ways. Number one, by altering the description or name or composition of the article subject to anti-dumping duty. Government found that Citizen Company of Japan is dumping wristwatches into India. Citizen Company of Japan is dumping wristwatches into India at a much cheaper price. They come to know. So they impose a duty. The duty is imposed on wristwatches imported from Japan by or from Citizen. Citizen is a company. So this action is pinpoint action. The duty will be charged not generally on importation of all watches. No. We will charge duty on only those watches which are being dumped at a cheaper price, and that too against a particular person who is dumping it. Okay. So government has imposed a duty. So what you do is, in order to circumvent, you mention that you are imported Casio watches or you are importing other brand of watches, but actually they are Citizen watches. So inside the box there will be Citizen watch, but on the bill, on the invoice, it will not be mentioned as Citizen watches. It will be mentioned as something else, some other brand. So you are trying to circumvent the imposition of anti-dumping duty by changing the description, altering the description or name, brand or composition of the article. You will mention that this is wall clock and not a wristwatch. Or where the composition is also important, like gold and like 24 karat gold or 13 karat gold. So you can change the composition. Or by import of such article in an unassembled or disassembled form. Suppose the imposition is on car. So instead of importing the car, you will import the kit. You will import parts and then assemble the car into India. After coming into India, assemble it in India. So we will bring the parts at a cheaper price and then we'll assemble it. So that is also circumvention. Or by changing the country of its origin. The duty was against Japan. Now you start importing it from China. You start importing it from Taiwan. Or any other manner. So either you change the description, name, composition, or you bring it in unassembled or disassembled form, or you change the country of origin, or any other manner, whereby the anti-dumping duty so imposed is rendered ineffective. It may extend, government may extend the anti-dumping duty to such articles originating in or exported from such country as the case may be. So government, what the government will do, it will extend the scope of this anti-dumping duty to cover those imports also. So that is the power of the government. Then in explanation, one definition is to be read: margin of dumping. What do you mean by margin of dumping? The difference between its export price and normal price. And what is normal price? Normal price means the comparable price in the ordinary course of trade for the like article when meant for consumption in the exporting country or territory. Meant for consumption in exporting country means what is the price at which these goods are sold in exporting country. That as adjusted by the differences between that market and export market. So the differences will be adjusted, if any, and then you get the normal price. Then there is another section, refund of excess duty charged, where the importer proves to the satisfaction of the central government that he has paid anti-dumping duty imposed under 9A on any article in excess of the actual margin of dumping. So when the government conducts the inquiry, it finds that the margin of dumping is 5,000 rupees. So they impose 5,000 duty on us. But later on we go to the government and prove that, look, the margin of dumping is not 5,000, it is only 2,000. It is there, but the margin of dumping is only 2,000. So therefore you should have charged 2,000 rupees of duty, not 5,000. So if we are able to prove this, then they will refund us the balance 3,000. So it says, the government as soon as may be reduce such anti-dumping duty as is in excess of the actual margin of dumping, and such importer shall be entitled to refund of such excess duty which was already collected from him. So that is a good section, 9AA. Then another section is there, 9B, no levy under section 9 or 9A, means that subsidy duty and anti-dumping duty, anti-subsidy, anti-dumping. Both these duties will not be levied under some situations. What are these situations? It says, notwithstanding anything contained in 9 and 9A, no article shall be subjected to both countervailing duty, that is anti-subsidy, countervailing, and anti-dumping to compensate for the same situation. Now see what happens, what this means. Foreign government has given, say, 25,000 subsidy to exporter of a car from US. Now that person has exported car to India, but this subsidy is only for export. So the person's price of car for sale inside US will be 25,000 more as compared to export price, because subsidy is given. So his export price will be cheaper by 25,000. So his domestic price is, say, 50 lakhs, export price 49 lakhs 75,000, 25,000 less. So this 25,000 can be called as dumping and can also be called as subsidy, because that is equal to subsidy which is received from US government. So can Indian government levy this 25,000 under both the sections? Under section 9 calling it as subsidy, and under section 9A calling it as dumping? No. They can choose any one. If you levy under section 9 as anti-subsidy, then you cannot levy anti-dumping for that same 25,000. Understood? So that's the first point. But that doesn't mean that both these duties cannot be charged at the same time. Take another example. That US price is say 10 lakhs. Export price is 9 lakhs. Means 1 lakh less. So 1 lakh is margin of dumping. But out of this, 25,000 is for subsidy. So 25,000 is because of subsidy, 75,000 is because of dumping. So we can charge duty under section 9 25,000 and under section 9A 75,000 for the same export. So that can happen. Then second point says the central government shall not levy any countervailing duty or anti-dumping duty by reason of exemption of such article from duties or taxes or refund of such duties and taxes. If it is fiscal decision of that government to exempt the export duty and therefore the goods are coming at a cheaper price, like it happens in our case. If we sell in India, it is chargeable to GST and all. If we export the goods, the GST is refunded. There is no GST. So obviously our export price will be less as compared to our domestic price. Because domestic goods are liable to GST, export goods are not liable to GST. So can the foreign government charge anti-dumping or consider this to be anti-dumping? No, it is not dumping. So taxation difference cannot be called as dumping. Okay. Secondly, on the import of any article from a WTO country or from a MFN country, WTO or MFN, most favored nation. MFN is a status we give to various countries. Or WTO, everyone knows, World Trade Organization. So if the import is from WTO or MFN country, then unless a determination has been made that import of such article into India causes or threatens to cause material injury, threatens to cause material injury to any established industry in India or materially retards the development of industry in India. So unless this declaration is given by the government, we cannot charge duty. So it's a technical requirement that if the importation is from WTO or MFN country and we want to impose anti-dumping duty, we can impose, but we have to give this declaration. The government has to conduct an inquiry and then give a declaration that look, you are giving subsidy or you are importing goods at a lesser price, cheaper price, and this is causing serious injury to our domestic industry. So this declaration has to be given. Then it says the central government may not levy any countervailing duty upon receipt of satisfactory voluntary undertakings from the government of the exporting country or territory agreeing to eliminate or limit the subsidy. If the foreign government gives the undertaking that we will stop giving subsidy, so we will say okay, we will stop charging this duty, simple. Or the exporter agreeing to revise the price of the article. Exporter says okay, my government is giving me subsidy, that's fine, but I will not pass on the subsidy, I will not give discount, I will charge full price. Then it's fine. If the goods are coming at full price, then it's fine. We will stop charging the duty. Or anti-dumping duty upon receipt of satisfactory voluntary undertaking from the exporter to revise his prices so as to cease exports to the area in question at dumped price. So he says okay, I'll revise my price upwards. I will not dump in India. If my normal price in US is $24, I will export also at $24. Simple. So these are the different types of duties, the auxiliary duties. And then there is one or two simple theory sections. Emergency power to impose or enhance the duties. So government has power to enhance the export duties. So that is given one very simple one. The central government may impose or enhance export duties by making amendments to the second schedule by way of notification in the official gazette. Conditions are goods may or may not be specified in second schedule, and the central government is satisfied that circumstances exist which render it necessary for imposition of or enhancement of export duties. Like for example, that some goods are being exported in a very heavy quantity and it may create a shortfall of those goods in India. Then government will charge this exorbitant duties. Like an example is given here about milk. That in summer season production of milk becomes low, and therefore to prevent shortfall in India we will stop its exports. Simple points. Then a topic is given. This is a general topic. A short note can come on this. What do you mean by project imports? Now what is a project import? Let me explain it to you before we read it. We are setting up a big factory in India, a big factory, and for this purpose we will have to import lots of plant, machinery and other equipments and apparatus and this and that into India. Lot of imports is going to take place, huge imports. 10,000 different varieties of plant and machineries are being imported, or maybe more than that. Now just have a look, just think that so many plant and machineries are getting imported. How will the custom clearance take place? Every time a big consignment comes, we'll have to go to that place, the port, Mumbai or wherever the goods are coming, and then see which goods have come, file the bill of entries, see the rates of tax applicable to them, open the customs tariff act, see each and every plant and machinery. I'll have to classify 10,000 plus plant and machinery, find out the rates, and then file bill of entries, and then so on and so forth. How many problems will arise? So many problems. So to avoid these problems, government has made this scheme called as project import. So project import by itself is a heading in Customs Tariff Act with a particular rate of duty. So whenever I am importing all my plant and machineries to set up a project, I am entitled to assess duty at that one specific rate on all my plant and machineries put together. So whatever is imported, I'll just write the project import rate this much and pay tax accordingly. No hassles, nothing. So that is this concept of project import. So see what it says. Project imports are imports of machinery, instruments, apparatus, etc. falling under different classifications required for initial setup or substantial expansion of an existing industrial unit. Items eligible for project imports are specified in heading 9801. So there is a specific heading for that, 9801, and a rate of tax. In a project, several different items are required, each of which is importable at different rates of custom duties, rendering it difficult to make assessment. Therefore, one consolidated rate of custom duty has been made applicable for all items imported under a project, irrespective of the nature of the goods and their custom classification. So we are not going to classify each machinery separately. Further, individual exemption notification will apply even for items grouped under the said heading of the customs tariff liable to duty at the project rate as per the recent Supreme Court judgment. So if there is exemption for any particular goods, particular machinery, we can claim that exemption also. Individual exemption applies. So if there are 5 machineries imported, 4 are taxable, 1 is exempt. So that exempt one will not be taxed. We will keep it aside. The value will be kept aside. The value of 4 machineries will be put together and charged at the group rate, project rate. And the projects which are allowed in this are industrial plants like factories, irrigation projects, power projects, you are setting up a power plant, mining, projects for oil and mineral exploration like ONGC and all, and other projects as notified by the government from time to time. And then last comparative chart is given, so this you can read, we have already discussed in detail, of all the auxiliary duties. Then a few questions are given there. Out of that, few are theory questions that you can read. We have studied all these sections. With reference to 9A, state briefly the provisions of refund of anti-dumping duty. So you have seen, just read it once. Mentions ways to constitute circumvention of anti-dumping duty, impose an article. That also we had seen. Then 8B, what shall be the safeguard duty? Not be imposed. So exceptions. And all these questions. So as far as the theory questions are concerned, you can go through it. We'll see one question, that is practical question number 6. Okay, so come down to question number 6. Determine the customs duty payable under the Customs Tariff Act of 1975, including the safeguard duty of 30% under section 8B. So there's a safeguard duty also at 30%. Apart from the basic custom duty and other cess, etc. Assessable value is 30 lakhs. Okay. From 26th February 19 to 25th February 20, both days inclusive. So it's a figure of 1 year. Sodium nitrate is getting imported from a developing country. The goods are coming from a developing country. And the share of imports from the developing country to India is 4% during this period. Means it is more than 3%. If it is more than 3%, then we can charge the safeguard duty, right? If it would have been less than 3%, then safeguard duty would not be charged. This we have studied. Very good. In 8B. Then basic custom duty rate is 10% and integrated tax is at 12%. No GST compensation cess. Ignore GST compensation cess. Very good. So let's see. So what we'll do is, first we'll take the assessable value 30 lakhs. To that we'll add the basic custom duty of 3 lakhs, that is 10%. Then we'll apply safeguard duty. Safeguard duty will be 30% of 30 lakhs and it will be charged because the ratio of import from that country has exceeded 3%. It is more than 3%, hence safeguard duty is chargeable. So that will be 9 lakhs, 30% of 30 lakhs. Okay. Then we'll add the SWS, Social Welfare Surcharge. Now make a correction here. Social Welfare Surcharge will be only on basic custom duty. It is not chargeable on safeguard duty. So this you cut off. So it will be only of 3 lakhs. 10% of 3 lakhs will be only 30,000. So if that is 30,000, then the total will come to 30 lakh plus 33 and 9, 42 lakh 30,000. Then on this 42 lakh 30,000, there will be 12% integrated tax. So that will come to 42 lakh 30,000 into 12%, 5 lakh 7,600. So total custom duty payable will be 3 lakh plus 9 lakh plus 120, make it 30,000 plus 5 lakh 7,600. So that total will be 3 lakh plus 9 lakh plus 30,000 plus 507,600. 17 lakh 37,600. Okay. So that's it. These were the different rates of duties.